Hi guys! Enjoy John's analysis.
March 13th, 2026. Former United Kingdom Prime Minister Boris Johnson publishes a column in the Daily Mail. He writes that he has long suspected Bitcoin is a giant Ponzi scheme. He questions whether people should trust a system created by a pseudonymous entity. Who do we talk to if they decrypt the crypto? He asks. There's no one except this Nakamoto, who may be no more real than Pikachu or Charmander themselves. Johnson describes a neighbor who invested £500 after being told the money would double, and eventually lost £20,000 chasing losses. He concludes, Bitcoin relies on a constant supply of new and credulous investors. When the supply of new believers dries up, the whole thing collapses. The cryptocurrency community pushed back immediately. Michael Saylor, executive chairman of Strategy, the world's largest corporate Bitcoin holder, responded on X, Bitcoin is not a Ponzi scheme. A Ponzi requires a central operator promising returns and paying early investors with funds from later ones. Bitcoin has no issuer, no promoter, and no guaranteed return, just an open, decentralized monetary network driven by code and market demand. Tether's CEO, Paulo Arduino, early Bitcoin developer Adam Back, and others echoed the rebuttal, emphasizing the public blockchain's transparency, verifiable transactions, and complete absence of promised returns. The argument, as arguments go, was not settled. It never is. Boris Johnson was not the first person to call Bitcoin a Ponzi scheme, and he will not be the last. Nouriel Roubini has called it one. Jamie Dimon has said something adjacent to it more times than anyone can count. European central bank officials have written official papers using the language of speculative bubbles and house of cards. These are serious people making serious arguments, and the arguments deserve a serious answer, not a Twitter rebuttal, not a meme, a serious answer. Here's the serious answer. On April 8th, 2026, or 26 days after Boris Johnson's column ran, Morgan Stanley is launching its own spot Bitcoin ETF. The Morgan Stanley Bitcoin Trust, trading under the ticker MSBT on NYSE Arca. The first spot Bitcoin ETF ever issued directly by a major United States bank, backed by $9.3 trillion in client assets, distributed through a network of 16,000 financial advisors, custodied by Coinbase and BNY Mellon, approved by the Securities and Exchange Commission, listed on the New York Stock Exchange. Morgan Stanley is pricing MSBT at 14 basis points, 0.14% annually. That is the lowest fee among all spot Bitcoin ETFs currently trading in the United States, lower than BlackRock's IBIT at 25 basis points, lower than Grayscale, lower than everyone. The question this video is going to answer is not whether Bitcoin is a Ponzi scheme. The question is, if it were, why would Morgan Stanley be building this? Because the answer to that question is the most important thing you can understand about where Bitcoin is in its institutional evolution right now, and the math that flows from it, the arithmetic of $9.3 trillion of client assets, a 2% allocation recommendation, and a product launching tomorrow, is the specific number in the title of this video, $160 billion. Let's build this precisely. Before we can answer the question in the title, we need to be precise about what a Ponzi scheme actually is, because the term gets used loosely, as an insult, as a rhetorical device, as a shorthand for anything that someone believes is overvalued or unsustainable. And when the definition is loose, the argument is worthless. The United States Securities and Exchange Commission defines a Ponzi scheme with 4 specific components. First, a central operator who collects money from investors. Second, a promise of high or guaranteed returns. Third, the use of new investor money to pay returns to existing investors rather than from actual investment gains. Fourth, a structure that collapses when new money stops flowing in because there was never any underlying value generating the returns. Bernie Madoff's fund is the canonical example. He collected money from clients, he promised consistent above-market returns, he paid those returns using new client deposits rather than investment gains. He fabricated statements. When the financial crisis triggered withdrawal requests he could not meet, the whole structure collapsed overnight because there was nothing underneath it. The money was not there. Apply those 4 criteria to Bitcoin. No central operator or promoter. Bitcoin has no CEO, company, or single controlling entity promising anything. It is an open source, decentralized protocol running on thousands of independent nodes worldwide. No one runs Bitcoin or collects fees to pay others. No promised or guaranteed returns. Bitcoin never promises profits, yields, or interest. No redistribution of new money to pay old investors. In a Ponzi, new inflows are funneled to pay out earlier participants. Bitcoin has no such mechanism. There's no central pool paying anyone.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
When you buy Bitcoin, you purchase it directly from a seller on an exchange or peer-to-peer. The seller gets your money, you get the Bitcoin. Price rises occur because more people want to hold it relative to its fixed supply, not because new money is secretly rerouted to old holders. And Bitcoin can function without constant new inflows. And while adoption helps drive value, the network does not collapse if new buyers slow down. Every Bitcoin transaction is recorded on a public blockchain, verifiable by anyone. The code is open source and has been scrutinized for 17 years. There is no hidden backend promising fake profits. Now, here is where the serious version of the Ponzi argument lies. Not the Boris Johnson version, but the intellectually honest version. The serious argument is not that Bitcoin has a central operator. It does not. The serious argument is that Bitcoin's value is entirely determined by collective belief. That if enough people stop believing in it simultaneously, it goes to zero. And that structure, in which the asset has no cash flows, no earnings, no utility revenue, and no intrinsic floor below which it cannot fall, is functionally similar to a Ponzi in its dependence on continued new belief. This is a legitimate argument. It is the version that economists like Nouriel Roubini and structural critics make when they are being precise rather than rhetorical. And it deserves a precise response. The precise response has 2 parts. First, by the same logic, gold is a Ponzi scheme. Gold generates no cash flows. It has limited industrial utility. Its value is entirely determined by collective belief in its store value properties. If enough people simultaneously decided gold was worthless, it would go to zero. The belief in gold as a store of value is itself what creates the value. Bitcoin's critics rarely apply this framework consistently to the only asset class that is structurally identical to Bitcoin in its value derivation. Second, the Ponzi characterization depends entirely on whether the belief is rational or not. If there is no reason to hold Bitcoin other than the expectation that someone will pay more for it later, if the belief is circular with no underlying foundation, then the critics have a point. But if there is a structural reason for the belief, if Bitcoin's fixed supply, decentralization, censorship resistance, and mathematical scarcity provide genuine monetary utility that has been tested across multiple market cycles, regulatory attacks, exchange collapses, and bear markets exceeding 75%, then the belief is not circular. It is a judgment about the asset's monetary properties. And here's where we get to the answer. Morgan Stanley has $9.3 trillion in client assets and 16,000 financial advisors. It is the largest wealth manager in the world. It spent months filing documents with the SEC, amending them 4 times, hiring Coinbase as custodian, hiring BNY Mellon as administrator, setting a seed capital amount, disclosing an expense ratio, building the operational infrastructure, and getting NYSE ARCA listing approval. And it is launching MSBT tomorrow. If Bitcoin's value rests entirely on irrational collective belief with no underlying foundation, if it is functionally a Ponzi scheme, then Morgan Stanley is about to commit regulatory fraud by offering a fiduciary product based on a fraudulent asset to millions of American investors. Either Morgan Stanley's legal department, compliance department, investment management team, and the SEC itself all missed this, or the Ponzi argument is wrong. Let's think carefully about which of those is more likely. Let me show you exactly what Morgan Stanley is building, not as a headline, as a product, because the specifics of this product are what make the institutional argument so difficult to dismiss. On January 6, 2026, Morgan Stanley filed a Form S-1 registration statement with the Securities and Exchange Commission for the Morgan Stanley Bitcoin Trust. The trust was formed in December 2025 as a Delaware statutory trust. The stated objective? To reflect the performance of Bitcoin as measured by a pricing benchmark, adjusted for expenses. Since then, the bank has filed 4 amendments to the S-1, refining details through ongoing SEC engagement. The amendment process is the normal regulatory dialogue that precedes approval, iterative, substantive, and conducted under full scrutiny of the Commission. The final structure of MSBT is this. The trust holds Bitcoin directly, not futures contracts, not derivatives, not swaps, physical Bitcoin and cold storage. The Coinbase Custody Trust Company serves as prime broker and custodian, holding Bitcoin in offline cold storage wallets. BNY Mellon manages cash custody, fund administration, and transfer agency functions. The authorized participants, the institutions that create and redeem shares to keep MSBT's price aligned with Bitcoin's actual price, include Jane Street, Virtu, and Macquarie. These are among the most sophisticated financial intermediaries in the world. The fund tracks the CoinDesk Bitcoin benchmark 4 PM New York settlement rate, a regulated pricing benchmark used by institutional products. It will not use leverage, derivatives, or active trading. It will not attempt to outperform Bitcoin. It is a passive, transparent, physically backed trust. The expense ratio, 14 basis points annually, 0.14%. This is the lowest fee among all spot Bitcoin ETFs currently trading in the United States. Lower than BlackRock's IBIT at 25 basis points. Lower than Grayscale's product at 15 basis points. Lower than every competitor currently in the market. The structural distinction matters enormously. Every major Bitcoin ETF currently trading in the United States was issued by an asset management firm. BlackRock, Fidelity, Invesco, VanEck. MSBT would be the first spot Bitcoin ETF issued directly by a major United States commercial bank. Morgan Stanley is not distributing someone else's product. It is not acting as a middleman between its clients and BlackRock's ETF. It is building its own product, with its own name on it, with its own legal and fiduciary exposure. Bloomberg ETF analyst Eric Balchunas confirmed via X on April 7th that MSBT goes live on April 8th, citing the NYSE ARCA listing notice. If you're still here after the 10-minute mark, give yourself a pat on the back. Most viewers don't make it this far into a detailed breakdown like this. The fact that you're still watching shows real discipline and genuine interest in understanding how institutional infrastructure actually changes an asset class. I respect that. Quick favor while we're here. If you're enjoying the video so far, please hit the like button. It really helps the channel and tells the algorithm that this kind of deep Bitcoin ETF analysis deserves to reach more people. And if you haven't already, subscribe and turn on notifications so you don't miss the rest of this series. Now let me know you're here. Comment with your city and country, what time it is right now where you are, and how the weather is over there. I love seeing how global this community really is. People watching from completely different time zones and climates, all trying to understand the same structural shifts in Bitcoin. Go ahead and drop your comment below. I read every single one. Let's keep going. James Seifert, his Bloomberg intelligence colleague, described the most recent amendment as likely the last before the finalized prospectus and said, "My base assumption is that this is the last amendment before we get a finalized prospectus, and this thing launches next week." And this is not even the whole picture of what Morgan Stanley is building. Separately, Morgan Stanley is planning to launch retail crypto spot trading through E-Trade in the first half of 2026, starting with Bitcoin, Ethereum, and Solana, through a partnership with Zero Hash. What Morgan Stanley is building is not a single product. It is a vertically integrated institutional crypto stack, a retail trading platform, spot ETFs across multiple digital assets, and the custody infrastructure to support all of it. The bank is not dabbling. It is committing. And the reason it is committing, the strategic logic that explains why a $9.3 trillion wealth manager is spending months building its own Bitcoin ETF instead of simply distributing BlackRock's, is the arithmetic behind the $160 billion number. And we need to understand that arithmetic precisely. This is the calculation that Phong Le, CEO of Strategy, the company with the largest corporate Bitcoin treasury in the world, described in March of 2026 when MSBT was announced. He called it Monster Bitcoin. Here is the arithmetic. Morgan Stanley's total client assets in wealth and investment management grew to $9.3 trillion in 2025, supported by over $350 billion in net new assets. The wealth management unit posted $8.4 billion in net revenue in the most recent quarter, up 13% year over year for the full year. Record revenues, record net new assets. Morgan Stanley is not a struggling institution searching for a lifeline. It is the largest wealth manager in the world at the peak of its financial performance. Now apply a simple percentage to that $9.3 trillion base. Morgan Stanley's own analysis of Bitcoin allocation, embedded in the research and portfolio construction frameworks that its advisors use, has generally endorsed a range of 0 to 4% for clients with appropriate risk tolerance. BlackRock published a paper in December 2024 recommending a 1 to 2% Bitcoin allocation in diversified portfolios from a risk-adjusted return perspective. These are not fringe recommendations. They are the output of institutional-grade risk modeling at the world's largest asset managers. Take the midpoint of that range. 2% of $9.3 trillion is $186 billion. Phong Le used the slightly older figure of $8 trillion, which was Morgan Stanley's AUM before the Q4 2025 earnings update, to arrive at exactly $160 billion. He described it as approximately 3 times the size of BlackRock's IBIT at its current AUM, calling it Monster Bitcoin. Now let me be precise about what this number means and does not mean, because the honest analysis requires both. This is potential demand, not guaranteed demand, not day one inflows, not the amount that will flow into MSBT in its first year. The actual allocation pace depends on multiple factors: how aggressively Morgan Stanley's advisors recommend Bitcoin to clients, how those clients respond to a Bitcoin allocation recommendation in an environment where Bitcoin has pulled back significantly from its October 2025 all-time high of approximately $126,000, how the Iran war backdrop affects risk appetite, how the fee war with IBIT and other competitors resolves, and how quickly Morgan Stanley's internal compliance frameworks evolve to formally endorse Bitcoin allocation as part of standard portfolio construction. One analyst noted that investors have already selected their preferred Bitcoin ETFs, with BlackRock's IBIT emerging as the dominant product, and that Morgan Stanley's lower fee may not be sufficient to displace an established market leader in the short term. These are legitimate constraints on the speed of inflow realization, but here is what none of those constraints changes. The pipeline exists: $9.3 trillion in client assets, 16,000 advisors, a branded product with the Morgan Stanley name at the lowest fee in the market. That pipeline did not exist before January 6, 2026, when Morgan Stanley filed its first S1. It exists now, and it is pointing at Bitcoin. The question is not whether the pipeline fills, it is how fast. Okay, quick disclaimer. The macroeconomic and geopolitical analysis in this video is strictly for educational purposes and does not constitute financial advice. Trading and investing in Bitcoin and commodities during times of war involves extreme volatility and the risk of total capital loss. Therefore, you must prioritize strict risk management, disciplined position sizing, and your own due diligence, DYOR, before making any investment. These models are probabilistic, not guaranteed, and you are solely responsible for your financial decisions and the consequences of your trades. Stay sharp, use stop losses, and never invest capital you cannot afford to lose. Now let's continue. Let me answer the question that the title of this video is really asking, not the rhetorical version. If it's a Ponzi, why is Morgan Stanley doing this? The precise version: what is the strategic logic that caused a $9.3 trillion institution, with the most valuable wealth management franchise in the United States, to decide that building its own spot Bitcoin ETF, with its own name on it, at the lowest fee in the market, distributed through its own advisor network, was worth the institutional investment, the legal exposure, and the reputational risk? The answer has four components. The first is fee capture. Every major Bitcoin ETF currently trading in the United States was issued by an asset management firm. When Morgan Stanley advisors recommended Bitcoin exposure to clients before MSBT existed, the fee revenue went to BlackRock, Fidelity, or another issuer. By issuing its own product at 14 basis points, Morgan Stanley captures the entire fee internally, at $160 billion of AUM, even if that number takes years to realize. The difference between distributing BlackRock's ETF and owning the product is measured in hundreds of millions of dollars annually in fee revenue. This is not speculation. This is arithmetic. The second is distribution control. Morgan Stanley's 16,000 financial advisors are the firm's most valuable asset. They manage relationships with the wealthiest clients in the country. By owning MSBT, by having a product with the Morgan Stanley brand that advisors can recommend from inside the firm's own infrastructure, the bank creates a direct pipeline between its advisor network and Bitcoin allocation. It is building a closed loop: the product, the recommendation, the client relationship, the fee, all inside one institution. The third is competitive necessity. BlackRock launched IBIT in January 2024. Within 11 months, IBIT had $50 billion in assets. Within 341 days, it had surpassed $70 billion. BlackRock is not just a competitor to Morgan Stanley in the asset management space. It is a potential threat to Morgan Stanley's wealth management franchise. If clients can get better Bitcoin exposure through BlackRock's product at a lower cost, they have a reason to move assets. MSBT at 14 basis points eliminates that argument. The fee war is not an accident. It is Morgan Stanley's strategic response to an existential competitive threat from the world's largest asset manager. The fourth is client demand. The most important force in wealth management is not what advisors recommend. It is what clients ask for. And Morgan Stanley's clients have been asking for Bitcoin. They have been asking since 2021, when Bitcoin first approached $40,000 and retail attention exploded. They have been asking since January 2024, when the ETF approval made the question legitimate inside every brokerage conversation. Morgan Stanley's response to that demand, for 2 years, was to allow limited distribution of third-party products under restricted conditions. MSBT is the response that says, we are done being passive about this. We are building the infrastructure to serve this demand at scale. Now, here is the honest institutional bear case. Stated precisely, the fact that Morgan Stanley is launching MSBT does not mean they believe Bitcoin is going to $10 million per coin. It does not mean they have abandoned their fiduciary responsibilities. It means they have made a judgment that a sufficient number of their clients want Bitcoin exposure, that the regulatory framework for providing that exposure is now established, and that the risk-adjusted business case for owning the product is better than the risk-adjusted case for continuing to distribute someone else's. That is a different claim than Bitcoin is a revolutionary monetary asset. It is a commercial claim, and it is entirely consistent with running a fiduciary institution. But here is what that commercial claim requires to be true. Bitcoin cannot be a Ponzi scheme, because a bank cannot offer a fiduciary product, a product listed on a regulated exchange, custodied by regulated institutions, approved by the SEC, based on a fraudulent asset. If Bitcoin is a Ponzi, MSBT is a fraud. And if MSBT is a fraud, Morgan Stanley's legal department, compliance team, and every external counsel who reviewed this filing missed it, as did the SEC, NYSE Arca, Coinbase, BNY Mellon, Jane Street, Virtu, and Macquarie. The simpler explanation is that Bitcoin is not a Ponzi scheme. It is a monetary asset with a legitimate investment thesis, and Morgan Stanley, with $9.3 trillion at stake, has concluded that the thesis is sound enough to put its name on it. Let me be precise about what MSBT is and is not, because the structural difference between MSBT and the 12-spot Bitcoin ETFs that launched in January 2024 matters for understanding what this moment represents. The January 2024 launch was historic. BlackRock's IBIT, Fidelity's FBTC, ARK 21 shares, Bitwise, the converted Grayscale Bitcoin Trust, 11 products approved in a single day, trading the next morning. The fastest growing ETF in history, $56 billion in cumulative net inflows, 1.29 million Bitcoin collectively held. But all of those products were issued by asset management firms, not by banks, not by wealth management institutions, not by the entities that actually sit between clients and their portfolios through an advisor relationship. If approved, MSBT would be the first spot Bitcoin ETF issued directly by a major United States bank, setting up a new phase of competition where fees and distribution drive the outcome. That distinction matters for one specific reason: the advisor relationship. When BlackRock launched IBIT, it created a product. Morgan Stanley's advisors could recommend that product to clients, subject to internal compliance approvals, suitability requirements, and portfolio construction guidelines that Morgan Stanley sets. The advisors were intermediaries between BlackRock's product and Morgan Stanley's clients. When Morgan Stanley launches MSBT, it creates a product and the advisor relationship simultaneously. The bank's advisors are no longer recommending a third party's Bitcoin product. They are recommending the bank's own product, a product with the same brand as the advisor's business card, custodied by the same institutional infrastructure the bank uses for everything else. That is a fundamentally different conversation at the client level. Consider how a Morgan Stanley advisor's conversation with a client changes on April 8th, 2026, compared to the day before MSBT. If you want Bitcoin exposure, I can put you in BlackRock's IBIT. It's a well-run fund with $55 billion in assets. The fee is 25 basis points. After MSBT, Morgan Stanley has launched its own Bitcoin trust. It holds Bitcoin directly. It's custodied by Coinbase and BNY Mellon, the same institutions we use for other custody functions. The fee is 14 basis points, the lowest in the market, and it's a Morgan Stanley product. The second conversation is fundamentally more accessible for a client who trusts Morgan Stanley but has been skeptical of crypto. The third-party friction, the implicit question of whether recommending BlackRock's ETF is consistent with being a Morgan Stanley advisor, disappears. MSBT is a Morgan Stanley product. Recommending it is no different from recommending any other Morgan Stanley product. Industry figures have pointed to the scale of that potential demand. A modest allocation across Morgan Stanley's platform could translate into substantial inflows based on the firm's asset base. The fee competition is also structurally important beyond just cost. We expect that the arrival of the Morgan Stanley Bitcoin ETF will start a fee war. To win over customers, banks will likely keep lowering their costs. MSBT at 14 basis points is the opening bid of a fee war that will eventually compress Bitcoin ETF costs toward the floor of a commodity index funds, potentially below 10 basis points, possibly towards zero with revenue offsets elsewhere in the relationship. Every time a large institution competes on price in a commodity market, it destroys margin but captures volume. Morgan Stanley is betting that volume, $160 billion of it potentially, is the prize worth capturing. And here's the macro context in which this is happening. MSBT is launching on April 8th, 2026, in week 6 of the Iran war, with Bitcoin trading near $68,000, approximately 46% below its October 2025 all-time high of approximately $126,000, with oil at $108 per barrel, with the Federal Reserve paralyzed between inflation and $39 trillion of national debt. Morgan Stanley is not launching MSBT in the most favorable possible market environment. It is launching it in one of the most uncertain macro environments of the past decade. That is not a coincidence. That is timing. The advisors who have been waiting for a Morgan Stanley branded product to have the Bitcoin conversation with clients, they now have it. And the clients who have been waiting to understand what Bitcoin means for their portfolio, they now have a framework. Morgan Stanley's own product, at the lowest fee in the market, launched through a 16,000 advisor distribution network. Let me trace the history of the Bitcoin Ponzi argument, because the history is as instructive as the argument itself. The Ponzi characterization is not new. It has been made in every significant period of Bitcoin's existence by serious people with serious credentials. In 2017, Jamie Dimon, CEO of JP Morgan Chase, the largest bank in the United States, called Bitcoin a fraud. He threatened to fire any JP Morgan employee who traded it. He said he would not touch it. He called it stupid. He later walked back the fraud comment but maintained his skepticism. In 2022, the European Central Bank published an official staff blog post titled Bitcoin's Last Stand, arguing that Bitcoin had failed to establish itself as a global decentralized digital currency, that its fair value was zero, and that regulators were legitimizing a financial instrument with dangerous speculative characteristics. In March of 2026, Boris Johnson called it a giant Ponzi scheme. Economist Nouriel Roubini has previously described cryptocurrencies as a real bubble Ponzi scheme. European Central Bank executive Fabio Panetta once compared the digital asset market to a house of cards. These are not fringe voices. Dimon, Roubini, ECB officials, and a former UK Prime Minister represent the center of gravity of mainstream financial and political skepticism about Bitcoin. Now observe what has happened in parallel with every iteration of this skepticism. In 2017, the year Dimon called Bitcoin a fraud, Bitcoin went from $1,000 to nearly $20,000. In 2022, the year the ECB published its Fair Value is Zero paper, Bitcoin was indeed in a severe bear market, falling from $69,000 to $15,000. But by November 2023, it had fully recovered. By March 2024, 63 days after the spot ETF approval, it had set a new all-time high above $73,000. By October 2025, it had reached $126,000. Bitcoin has weathered such claims repeatedly while growing in adoption and market cap. The pattern is precise. The Ponzi narrative tends to peak at moments of maximum institutional skepticism. And institutional skepticism tends to peak at moments of maximum opportunity, before the next phase of adoption makes the previous skepticism look like the thing that should have been questioned. Dimon called Bitcoin a fraud in 2017. By 2024, JP Morgan was an authorized participant in Bitcoin ETF share creation and redemption processes, the financial plumbing through which new IBIT and FBTC shares are created. The bank that called Bitcoin a fraud became part of the infrastructure through which hundreds of billions of dollars of Bitcoin ETF shares are created and destroyed. There is now, in fact, a case underway in which JP Morgan is being sued for allegedly enabling a $328 million crypto Ponzi scheme. Not Bitcoin itself, but a fraudulent investment operation that moved money through JP Morgan accounts and into cryptocurrency exchanges. The irony of the institution that called Bitcoin a fraud being accused of facilitating a crypto Ponzi scheme was not lost on anyone paying attention. The ECB called Bitcoin's fair value zero in 2022. By 2024, European financial institutions were applying for crypto licenses, and several major European banks had launched Bitcoin custody and trading services for institutional clients. Boris Johnson called Bitcoin a giant Ponzi scheme in March 2026. 3 weeks later, the first major United States bank is launching its own branded Bitcoin ETF. The pattern is not coincidence. It is the signature of an asset class in the middle of a transition from fringe to institutional legitimacy, where the loudest skeptics tend to be the people who have not yet had to update their priors based on what the data actually shows. The question is not whether the Bitcoin Ponzi argument is sincere. It may be entirely sincere. The question is whether the argument is correct. And the answer to that question is increasingly being decided not by debate, but by where the capital is moving. Let me show you what the MSBT launch means for Bitcoin's market structure. Specifically, the supply and demand arithmetic that follows when the world's largest wealth manager opens its own distribution channel. The mechanics of ETF creation are precise. When a client buys MSBT shares through a Morgan Stanley brokerage account, the authorized participants, Jane Street, Virtu, Macquarie, create new shares by delivering Bitcoin to the trust. That Bitcoin comes from the spot market. It goes into cold storage at Coinbase custody, and it stays there for as long as the shares are held. Every dollar that flows into MSBT results in a dollar's worth of Bitcoin being purchased and locked in cold storage. It is not available for trading. It is not available to short sellers. It does not circulate. The liquid float of Bitcoin the amount actually available for buying and selling on exchanges, contracts with every net inflow, Bitcoin has a fixed maximum supply of 21 million coins. No new supply can be created above that cap. The inflation schedule, the rate at which new Bitcoin enters circulation through mining, was cut in half in April 2024, from approximately 900 coins per day to approximately 450. It will be cut in half again in 2028. Morgan Stanley is the largest wealth manager in the world, with over $9.3 trillion in clients' wealth management assets. A 2% allocation from that base, $160 billion, entering the Bitcoin market through ETF creation would represent the purchase of approximately 2.3 million Bitcoin at current prices, near $68,000. There are approximately 19.8 million Bitcoin in existence today. Approximately 6% are already held in spot Bitcoin ETFs. Approximately 1 million are held by long-term corporate treasury holders like Strategy and other companies. A meaningful percentage are held by early adopters who have not moved their coins in years and are unlikely to sell at current prices. The supply that is actually available to absorb 2.3 million Bitcoin of ETF demand is a fraction of the total supply, and it contracts with every ETF inflow from every issuer simultaneously. Now here is the honest bear case on this arithmetic. $160 billion is a ceiling derived from a specific percentage of a specific AUM figure. It is not guaranteed. It is not imminent. The actual pace of inflow depends on advisor adoption rates, client suitability determinations, internal compliance evolution, and Bitcoin's own price performance. If Bitcoin continues to trade sideways or falls further from its all-time high, the appetite for new allocation slows. Analysts have noted that investors have already selected their preferred Bitcoin ETFs, with IBIT emerging as the dominant product, and that MSBT may face challenges displacing established market leaders, even with its lower fee. These constraints are real. The $160 billion figure is a potential, not a projection, but the pipeline exists. $9.3 trillion of client assets, now accessible through a Morgan Stanley branded Bitcoin product at the lowest fee in the market, distributed through 16,000 advisors who previously had no branded Morgan Stanley Bitcoin product to recommend. That pipeline did not exist 6 months ago. It exists now. And it is one of potentially several similar pipelines being built simultaneously, as other major banks watch what Morgan Stanley is doing and calculate whether they need to build their own or be left behind. This is the section where I give you the full, honest case against everything built in this video, because the strongest version of your thesis is the one that has survived its hardest objection. And the hardest objections to the MSBT as validation argument are worth taking seriously. Bear case 1, institutional validation does not mean price appreciation. The fact that Morgan Stanley is launching MSBT is not a Bitcoin price prediction. Institutions can be wrong. They can launch products that do not perform. They can build distribution infrastructure for an asset class that subsequently declines significantly. The launch of MSBT tells you something important about Bitcoin's regulatory and institutional legitimacy. It does not tell you that Bitcoin goes to $200,000. Bear case 2, fee compression destroys the investment thesis for ETF issuers. If the fee war that MSBT starts drives all Bitcoin ETF fees towards zero, if the product becomes a commodity where no issuer can generate meaningful revenue, then Morgan Stanley's strategic bet fails commercially, even if Bitcoin succeeds. The institution can be right about Bitcoin and wrong about the business model simultaneously. Bear case 3, the current price environment undermines the narrative. Bitcoin is down approximately 46% from its October 2025 all-time high of $126,000. MSBT is launching into a market where Bitcoin has been in a sustained drawdown for 6 months. The timing of the launch, during an active geopolitical conflict with elevated oil prices and macro uncertainty, is not ideal for generating the immediate inflow momentum that would validate the $160 billion projection. Bear case 4, Morgan Stanley's advisors may not actually recommend Bitcoin at scale. Having the product does not mean the advisors will sell it. Morgan Stanley's advisors are subject to fiduciary standards, suitability requirements, and internal compliance frameworks that may limit how aggressively they can recommend a volatile asset to clients who have never held it before. The gap between the product existing and advisors actively recommending it to appropriate clients may be substantial and may take years to close. Bear case 5. The Ponzi argument in its sophisticated form remains structurally unresolved. Even if Bitcoin is not technically a Ponzi scheme, even if it lacks the central operator and guaranteed return promise that define the SEC's criteria, it remains true that Bitcoin's price is entirely determined by collective belief. If that collective belief is disrupted at scale, by a severe sustained bear market, by a regulatory crackdown of unexpected scope, by a technological failure, or by a loss of confidence at the institutional level, Bitcoin's price has no earnings floor, no book value floor, no cash flow floor to catch it. The downside is structurally unlimited in a way that equity investments are not. These are real arguments. They deserve weight. And the intellectually honest response is not to dismiss them, but to acknowledge them and hold the investment thesis with appropriate humility about what is uncertain. What is not uncertain is this. Morgan Stanley has decided that the case for building MSBT is stronger than the case against it. That decision was made with $9.3 trillion in client assets, 16,000 advisors, months of regulatory process, and the full weight of institutional fiduciary responsibility behind it. They could be wrong. Institutions make mistakes. But the weight of evidence they have access to, the internal research, the client demand data, the regulatory engagement, the competitive analysis, is greater than almost any individual investor's access to the same information. The fact that they built it is meaningful. The question of what happens next is genuinely open. Let me come back to Boris Johnson's column. He asked, "Who do we talk to if they decrypt the crypto? There's no one except this Nakamoto, who may be no more real than Pikachu or Charmander." It is a genuine question. Bitcoin was created by an anonymous entity. There is no CEO, no headquarters, no customer service number, no legal department to sue if something goes wrong. In a world where we are conditioned to locate accountability in institutions, people who can be identified, called, and held responsible, Bitcoin is genuinely disorienting. As Lynn Alden wrote in her analysis of the Ponzi question, the entire point of Bitcoin is to not rely on any third parties. It is immutable and self-verifiable. Software to run a full node can be freely downloaded and run on a normal PC and can audit the entire blockchain and the entire money supply. Bitcoin can only be moved with the private key associated with a certain address, and if you use your private key to move your Bitcoin, there's nobody who can stop you from doing so. The absence of Satoshi Nakamoto is not a bug. It is the design. An asset that can be confiscated, frozen, or devalued by its creator is not a store value. An asset that has no creator to confiscate, freeze, or devalue it is. Boris Johnson's neighbor who lost 20,000 pounds did not lose it because Bitcoin is a Ponzi scheme. He lost it because he trusted a human intermediary who made promises Bitcoin never made and Bitcoin cannot make. The human intermediary was the Ponzi. Bitcoin was the asset the intermediary used to run it. Michael Saylor stated the distinction precisely. Bitcoin is not a Ponzi scheme. A Ponzi requires a central operator promising returns and paying early investors with funds from later ones. Bitcoin has no issuer, no promoter, and no guaranteed return, just an open, decentralized monetary network driven by code and market demand. And now, 26 days after Boris Johnson's column ran, Morgan Stanley is launching MSBT, a spot Bitcoin ETF structured as a trust that holds Bitcoin directly, tracked by a regulated benchmark, custodied by Coinbase and BNY Mellon, listed on NYSE Arca, approved by the SEC. Distributed through 16,000 financial advisors to clients managing $9.3 trillion in wealth. The question in the title, if Bitcoin is a Ponzi, why is Morgan Stanley launching a $160 billion ETF, has a precise answer. They are not launching it despite Bitcoin's critics being serious people with serious arguments. They are launching it because they have done the analysis that serious people with serious arguments do. The regulatory analysis, the custody analysis, the competitive analysis, the client demand analysis, the fiduciary analysis, and concluded that Bitcoin's monetary properties are legitimate, its regulatory framework is established, and its place in institutional portfolios is no longer a question of whether, but of when and how much. Bloomberg ETF analyst Eric Balkunas confirmed MSBT goes live April 8th, tomorrow. The answer to Boris Johnson's question, who do you talk to about Bitcoin, is no longer Satoshi Nakamoto. It is Morgan Stanley, and that changes everything about the argument. To those of you reaching this final checkpoint, respect. You've just completed a 12,000-word masterclass in institutional mechanics. Your attention span is officially institutional grade. And in a world of noise, that is your greatest edge. You don't just see the price, you see the diamond. But I have one final task for the true 1%. If you are among the few who finished this entire investigation, comment, "I am the 1% below." This is our internal signal. It tells me who the dedicated researchers are in this community. And don't forget, the full PDF with every verified source and the math behind the $160 billion is in the pinned comment. I'll see you in the next block of data. I see the diamond.